In early 1600s in Amsterdam, shares of the Dutch East India Company could only officially be transferred from one individual to another every 90 days when the company would open its actual transfer books. This way, it was easier for the company to keep track of who owned shares for the purpose of, say, voting or dividend distribution, but it also meant that shares could only officially change hands quarterly. Very quickly, the brokers of the market began to create what were called derivative contracts, forward contracts on the future price of these sorts of shares. Now, even though individuals could not buy a share, what they could do was buy the right to purchase a share at a future date at a pre-negotiated price. And this allowed for a market price of shares to fluctuate in between the actual dates when ownership would change. Now, at the same time, we also see the beginnings of option contracts being traded in Amsterdam, which gave the purchaser of the contract the right to decide whether or not to exercise it. In general, if open market prices were advantageously different than the contracted prices, then the contract buyer could either exercise their contract or simply walk away. Whereas if someone had used a forward contract, a standardized way of buying Dutch East India Company shares between security changeover dates, then they would be legally required to complete the trade. So the difference between a forward and an option is ultimately that the option gives the purchaser of the contract the right to choose whether they want to complete the contract or not. Now, of course, this is a lot more flexible than a forward contract is. And as a result, the purchasers of options have to pay a higher price to those who are selling these kinds of derivative contracts. But nonetheless, they do provide a lot more flexibility to the purchaser. Now, of course, with this additional flexibility also comes difficulties in calculating the appropriate price to charge for that kind of flexibility. And it took until well into the 20th century before we were able to properly quantify the risks that this posed to investors, leading to substantial improvements in their pricing. We'll get to that part of the story a little bit later. For now, what I'd like to focus on is a particular incident in Dutch financial history that doesn't put them quite in as good a light, as you might think, as the development of public stock markets and mutual funds and so many other financial innovations in the early 1600s. Around this particular time, we notice that the Dutch East India Company has become quite successful and that the wealth that it's generating is fairly widespread in society. There is a very strong nouveau riche market that is developing in the Netherlands. Families of merchants who had otherwise done okay or well for themselves were now finding themselves doing quite well. And as a result, we're finding that they were in effect in a sort of signaling arms race with one another to demonstrate that they were in fact the beneficiaries or participants in the particularly valuable trade that was taking place with the East Indies. Now, the number one source of this sort of competition for the trappings of wealth was the tulip. Tulips are not a native flower to the Netherlands. They're in fact from Turkey. And on top of that, the bulbs ultimately need to be planted underground for months at a time before this can yield any kind of sellable product. And this means, of course, that there was a clear opportunity for a speculative market to develop in certain kinds of tulips. Now, you might wonder why anybody would bother to speculate in tulips. They are pretty flowers, but realistically, it seems a little bit unusual. The story gets started when we note that certain kinds of tulips can be infected with a certain kind of parasite that causes them to have unusual patterns in their blooms. And the more unusual the patterns were, the rarer they were, ultimately, the greater value they had. And thus, people would speculate on whether or not certain bulbs would be able to produce certain kinds of beautiful, valuable patterns. But of course, it wasn't really obvious what the results would be until, of course, bulbs could be lifted, generally in February each year. Now, what started off as fairly simple and orderly trading among people who were looking to acquire certain kinds of foreign goods very quickly took on the tone of a financial bubble. The story of this begins off at a drunken party in the southern Netherlands in Brabant, where a number of merchants have met together and are bidding back and forth about certain rare tulip bulbs that they are hoping to acquire or expecting to acquire. And as the night goes on, what starts to happen is people start to bid up prices, as usually happened in pubs or coffee houses among financial types at the time. But prices began to be bid up. And then the unusual thing began to happen. People took out positions that were completely hedged. They would offer to buy certain bulbs for, say, a price of 5 guilders, only to offset this with a contract to sell that same bulb for 6 guilders to someone else. And so what very quickly happened was a speculative greater fool's game, where many people were offering to buy different kinds of rare bulbs merely on the hope of being able to sell them to someone else who would finally take delivery, which effectively was like flipping houses, people bidding back and forth on assets, hoping to only hold them for a very short period of time and offset any risks they might face of actually having to take expensive delivery by having a contract to resell those same goods to someone else. As a famous play dated shortly afterwards point out, the Dutch character Galgo says that I will pay you as soon as my buyer pays me. And of course, you can see where the problem begins to arise. What you end up with is a series of bilateral forward contracts that get initiated between individual speculators. This effectively becomes a pure paper trade. There are no goods actually changing hands yet, and no goods will change hands until early February when deliveries can begin to be made. On the other hand, what we see are people who are caught up in a speculative frenzy and who see great possibilities for wealth before their eyes. There's one probably exaggerated story that emerged in the aftermath of the bubble that described one trader being willing to pay as high a price as 12 acres of land for just a single tulip bulb. Now, of course, the biggest problem that we end up with is the possibility of default. As we had one person in a chain of contracts that suddenly chose to not pay because the price was too high, then all of the other people behind them in line who are expecting to get paid through this series of contracts will all find themselves dealing with a default as well, which is exactly what happened. Prices on a number of bulbs were bid up to ridiculous levels, some as high as 20 or 60 times their average market price. And when people failed to actually show up and honor the agreements that they'd made in early February, the prices in the market quickly collapsed. You can see a painting up here lampooning the sorts of trading that people got involved with, where simply all of these tulip traders have been replaced with monkeys. Needless to say, most people didn't think particularly highly of the speculators who had gotten involved in the tulip bubble and lost so much money. So you can see here an index of tulip prices in the Netherlands, starting in early November, with an average index rating of about 10, rising as high as 200 by February 3rd. In just the span of three and a half months, we see the price of tulips on average rise by a factor of 20, a clear bubble if anyone was bothering to look. Now, of course, when people failed to show up, the bubble ultimately collapsed, and this led to a series of lawsuits for people having violated their contracts, promises to show up and buy tulip bulbs in exchange for 3 cows and a goat. These sorts of things just simply did not occur. Everyone had expected to simply sell off their bulbs at a higher price, but when those people who had promised the highest price did not deliver, of course, this set off a chain reaction. By the end of February, the traders had decided to hold a meeting and established that any kind of trades that had been entered into after November of 1636 would instead be treated as an options contract, where people would have the right to buy the bulbs if they wanted to. But if people chose not to, there would be a 10% break fee that would be applied to any of these contracts. This was challenged in court, and finally, the next year, the High Court in the Netherlands decided that the maximum magnitude of this break fee that would be used to settle up these transactions was just 3.5% of what had been promised. Needless to say, the episode of the Tulip Bubble reveals a key weakness in the design of forward contract trading. And this is the idea that bilateral chains can be created where the same contract is might have a single contract between two parties, but this doesn't prevent that second party from entering into another bilateral contract and that third party from entering into another bilateral contract, ostensibly to hedge all of these transactions along the way. This is the kind of thing that helped create problems during the 2008 financial crisis, which we'll be getting to shortly. But needless to say, there was some important designs that needed to be updated with regards to the forward trading of commodities if we were to try to resolve this problem of derivative chains.